Imagine you're standing on a farm somewhere in North America. The farmer in front of you is looking at a tractor that's been working for years. It still runs, but it's getting older, repairs are becoming frequent, and productivity is starting to suffer. Now pause for a moment and ask yourself, when does a farmer decide to replace a machine? Not when headlines tell him to. Not when economists predict growth. And certainly not because the stock market wants him to. He replaces it when business conditions improve enough that buying a new machine makes economic sense. That simple idea is where the story of Uniparts begins. Uniparts is not a company that most retail investors talk about every day. It doesn't sell smartphones, software subscriptions, or fashionable consumer products. Instead, it operates in the world of agricultural machinery and construction equipment. Think of it as one of the specialist engineers quietly supplying critical components that help tractors, loaders, excavators, and industrial machines function smoothly across the world. This is what Charlie Munger would call a hidden toll booth business. The machines may carry the branding of large global manufacturers, but behind the scenes, there are specialized suppliers whose products are essential for those machines to work. Uniparts sits in that ecosystem. To understand where the company stands today, we must first understand the industry. For the last few years, agriculture and construction equipment markets have faced significant headwinds. Farmers delayed purchases. Equipment dealers reduced inventories. Higher interest rates discouraged investments. Global uncertainty slowed decision-making. Manufacturers cut production. This created what investors call a cyclical downturn. A cycle is simply the market's version of breathing. Sometimes industries inhale and expand. Sometimes they exhale and contract. The important thing is recognizing where you are in that breathing pattern. Today, management believes the industry has moved past the deepest part of the exhale. Construction activity is being supported by infrastructure spending, manufacturing investments, energy transition projects, and the explosion of digital infrastructure, such as data centers. Agriculture, while still uneven, is beginning to stabilize. Farmers are gradually returning to replacement purchases. Inventories are being replenished. Order books are improving. These are not dramatic headline events. They are small signals. And investing often rewards people who can interpret small signals before they become obvious trends. This brings us to an important mental model called second-order thinking. First-order thinking says, business is improving. Second-order thinking asks, if business is improving, who benefits first? The answer is often not the final equipment manufacturer. The answer can be the specialized supplier that sees orders increasing before the full recovery becomes visible to everyone else. That is precisely why investors pay attention to companies like Uniparts. Now let's move from the industry to the company itself. One of the most encouraging aspects of the recent performance is not simply that revenue increased. Revenue can grow for many reasons. The real question is, why did it grow? Management repeatedly emphasized that growth was largely volume-driven rather than price-driven. This distinction matters. Imagine a restaurant. If revenue grows because menu prices increased, customers may eventually push back. But if revenue grows because more customers are filling the tables every evening, that's a stronger signal. Volume-led growth suggests genuine demand. And genuine demand is usually more durable. This is where another mental model becomes useful. Signal versus noise. Price increases can be noise. Volume increases are often the signal. The company is reporting stronger order books, new business wins, and increasing customer activity. These are signals suggesting that the recovery may have real substance behind it. What makes the story more interesting is that profitability is improving faster than sales. This is known as operating leverage. Operating leverage is one of the most powerful concepts in business. Imagine owning a cinema. Whether 50 people watch a movie or 150 people watch it, many of your costs remain the same. Once fixed costs are covered, additional revenue starts contributing disproportionately to profit. Businesses experiencing operating leverage often surprise investors because profits accelerate much faster than revenue. That appears to be happening here. The company has remained disciplined during the difficult years. Expenses were controlled. Investments were made carefully. Efficiency improved. Now, as demand returns, those preparations are beginning to show results. This creates a classic flywheel effect. A flywheel is a heavy wheel that initially takes tremendous effort to move. At first, nothing seems to happen. Then slowly momentum builds. Eventually, the wheel starts spinning faster with less effort. Business recovery, operating leverage, stronger cash generation, and new order wins are all contributing force to the same flywheel. The market loves businesses when the flywheel starts turning. But every good story must include the challenges. A mature investor never ignores risk. The agriculture sector remains cyclical. Global geopolitics can disrupt supply chains. Raw material inflation can create pressure. Currency movements can create temporary distortions. Demand recovery may not always be smooth. These are real headwinds. However, what is noteworthy is how management discusses them. Instead of promising perfection, they speak about preparation, flexibility, and execution. That tells us something important about management quality. Great management teams focus on controllable variables. Average management teams focus on excuses. The recent fire incident at one facility could have become a major disruption. Yet operations continued through alternate arrangements and customer deliveries were maintained. This demonstrates organizational resilience. Resilience is often underestimated by investors because it doesn't appear directly in financial statements. Yet resilience frequently separates long-term winners from long-term losers. Now let's connect fundamentals with what many market participants observe through price behavior. Think of price as the shadow. Think of price as the shadow. Think of fundamentals as the object creating the shadow. Many traders spend all their time analyzing the shadow. Many investors spend all their time analyzing the object. The best opportunities often appear when both begin moving in the same direction. When earnings improve, order books strengthen, cash generation accelerates, and industry cycles recover, the foundation becomes stronger. When market participants gradually recognize these improvements, price eventually starts reflecting that reality. This synchronization between business improvement and market recognition is what often creates powerful trends. Another useful concept here is institutional accumulation. Most large investors cannot buy entire positions in a single day. They accumulate gradually. Like filling a swimming pool with a garden hose, the process is slow and often invisible at first. The signs are usually indirect. Improving earnings, consistent execution, strong cash flows, increasing business wins, expanding profitability, a strengthening industry backdrop. These are often the footprints left behind before broader market recognition occurs. The total addressable market for Uniparts remains significant because the company serves large global agriculture and construction ecosystems. Even small increases in market share or customer wallet share can create meaningful growth opportunities. This is where scalability enters the picture. Scalability means the company has room to grow without needing a proportional increase in resources. Management continues to highlight opportunities in precision machine parts, new customer programs, global warehousing initiatives, and geographic expansion. Each of these acts like an additional runway extending in front of the aircraft. The longer the runway, the further the business can potentially travel. So what is the real takeaway from this story? Not that the company had a strong quarter. Strong quarters come and go. The deeper observation is that several independent pieces of evidence are starting to align. The industry cycle is improving. Customer demand is recovering. New business wins remain healthy. Margins are expanding. Cash generation is strong. The balance sheet remains healthy. Management guidance remains constructive. When multiple independent signals begin pointing in the same direction, investors call it confluence. And confluence is often where conviction is born. Before we end, let me leave you with a question. If you walked into a room full of investors 5 years from now and someone asked, when did the recovery story actually begin? Would the answer be when the headlines became obvious? Or would it be much earlier, when only a handful of small signals were quietly telling the story? That question is worth thinking about. Because in investing, the biggest rewards rarely come from recognizing the story after everyone sees it.
Don't forget to like and subscribe. Don't forget to like and subscribe.